Chapter 11, Retirement and Other Tax-Deferred Plans. Learning Objective 3. Here we're going to look at individual sponsored plans. So this is unlike defined benefit and pension plans or employer-sponsored defined contribution plans like a 401k or 403b, which is essentially equivalent provision for some tax-exempt nonprofit and educational institutions. Here, individuals can put a certain amount away, and specifically we're talking about $5,500 for an individual. And then if you're over the age of 50, that amount is going to be raised to $6,500. So a married couple with two spouses would have two contributions, so the total of $11,000 for a married couple. And the purpose is going to be to essentially shield growth from taxation or tax it, defer the taxation of it. So there are two big ways that this is going to be done. One is with the traditional IRA. So here we're going to get a deduction for AGI, or for the adjusted gross income, up front. And then tax withdrawals are going to be fully taxed on the distribution. So here we're deferring taxes on essentially the principal itself, as well as on any gains that principal makes until distribution in the retirement years. And the second is going to be the Roth IRA. So it's not deducted, but the distributions are not going to be taxed. So this is kind of like prepaying the tax, where we're going to take the tax on the principal, but any gains that are made, as well as any distributions from that principal, are not going to be taxed in the retirement years. So for the traditional IRA, if you are not covered by an employer-sponsored plan, then you're going to unconditionally be able to contribute that $5,500 per individual or $11,000 per married couple. If you are contributing also to a 401k, so you're an active participant in one of those employer-sponsored plans, then there's a phase-out for your ability to participate in the traditional IRA. For single taxpayers, that phase-out is going to be from $63,000 to $73,000. So if you make $63,000 for your gross income, then you are going to be able to contribute $5,500. If you make $73,000, then you'll be able to contribute nothing. So if you're just into the phase out, say $64,000 for your income, you're going to have $550 that's the contribution that's going to be removed. So you'll be able to contribute $4,950, and then if you're at $72,000, then you're going to have all of it excluded, except for you'll only be able to make a contribution of $550. And similarly with married couples, you're going to get a $20,000 range from $101,000 to $121,000. So $101,000 you can contribute the $11,000. $121,000 you would not be able to contribute anything to the traditional IRA. And then if you're say $2,000 in at $103,000 into the phase-out period, then you're going to have $1,100 excluded. So you will be able to contribute $9,900 collectively. If you're at $119,000 for your joint gross income that's reported, then you will only be able to contribute $1,100, so $550 per spouse. Now, married couples are going to get that $11,000 even if one of the spouses doesn't work. So it's not going to be limited by an individual gross income, as long as collectively the amount's over that $11,000. And if one of the spouses is covered by an employer-sponsored plan and the other spouse is uncovered, then the non-covered spouse can still contribute up to the dollar limits, provided that the AGI, or adjusted gross income, is going to be less than $189,000, and it will have a $10,000 phase-out limit. So between $189,000 and $199,000 would be when that $5,500 contribution would get phased out. Now the second one we looked at here was going to be the Roth IRA. So this is the one that's not deductible, so it is taxed up front, but the distributions or withdrawals in the retirement years are not going to be taxed. The contribution limits here are going to be the same as with the traditional IRA, so $5,500 for a single individual, $11,000 for a married couple, and that amount is going to raise from $5,500 to $6,500 for individuals over 50. Here, the phase-out, though, is going to start at $189,000 for married filing jointly, and there's the $10,000 phase-out period. So from 189,000 to 199,000, and the phase-out period for single individuals would be 120,000, and have a $15,000 range there. So from 120,000 to 135,000. And then the percentage that you're through the phase-out period would again get multiplied by the 5,500 for single individuals, or 11,000 for joint. Now, the taxpayer essentially is getting to choose whether they want taxed now on the amount that they're putting for retirement, and then not taxed on the distributions and withdrawals, or whether they want to be not taxed currently, and then defer all taxes for that withdrawal and distribution period. And that's something that individuals will have to make a determination on which is going to be more tax advantageous to benefit for them if they're deciding between the two different plans. And one thing to consider is the tax rate that you're currently being taxed at, and then what tax rate you project or believe that you will be at for that withdrawal and distribution period. So that's going to be part of the calculation for if you're deciding between investing a certain amount of money in either a traditional IRA or Roth IRA that you'll want to take into consideration. So taking a look at our concept check here. The first says two types of individual sponsored retirement plans are, and that's going to be the traditional and Roth IRAs. Concept check 2, a single individual age 58 with a wage of $30,000 can make a tax deductible contribution up to a certain amount to a traditional IRA, and because the individual is over 50, that amount's going to be the $6,500. So they're going to get the increased limit. Concept check 3, a married couple who are not participants in an employer retirement plan with earned income of $200,000 are ineligible to make a deductible contribution to a traditional IRA. And we know that is false. And concept check 4, generally distributions from a Roth IRA are not taxable. True or false? And that is true.